Hey there.
Hi, Michael.
How are you?
I'm good. I'm good. How are you doing?
Good.
Um,
It's been some time.
yeah, it feels like it's been a couple of months since we last talked. Yeah, thanks for having me back to talk to your Seeking Alpha people and others.
Well, we appreciate the time. So, since we last talked, why don't you just give an update of what you've been doing and where you're at, and maybe what you're going to be doing here in the
Sure.
fall, in the autumn?
Yeah, so I think since we last talked, I was working on a feature for the DCEO Energy Awards edition and the event that's coming up at the end of October. Um, I'll be able to talk about that once it's published, but it's really deep into the US shale story, looking at it really from a wide angle lens, and just how it's evolved and that sort of thing. Because I've been chronicling it, as you know, for like a long time,
Mhm.
almost 2 decades, really. And then also, I'm going to be giving a keynote in Montana at the University of Montana for their Central and Southwest Asian Studies Conference. And I'll be talking about energy, the energy transition, and geopolitics, basically. And it's going to be a really interesting conference, a lot of global topics, geopolitics, AI, even because Missoula, Montana, where this is being held, is, believe it or not, Montana's tech capital. Like Austin is ours and Missoula is theirs, and it's a growing industry there. A lot of people want to move to Montana. It's beautiful. And then the other thing, I just did a video interview about CCS, carbon capture, a second. And some of that was just like in advance of Montana, just trying to kind of discuss some of the energy transition happenings relative to, the IRA legislation, hydrocarbons, decarbonizing and all that. So so it's been heavy on the research side, pretty much, I would say.
You've been busy.
Yeah, trying to be. So is there anything else before we hop into some slides?
Yeah, let's jump into the slides because I think you got kind of a good just background layout of where things have been going.
Okay, let me screen share and we can look at all that. Let me get my windows up. Um, Here we go. Okay, so I was going to talk a little bit about this. This struck me. It's EV deployment by country from 2012 to 2022. It's a little bit of cut off here. And if you notice, most of the countries where there is a high degree of EV penetration are in country like Scandinavian countries, Norway, Iceland, Sweden, Denmark, Finland, very green leaning countries, the Netherlands, small countries, Germany, car industry, with a government that's, been trying to push that as well. China, which is very much policy driven, and it's very much a strategy of theirs is, to be EV and, clean tech leaders. Belgium, small country, green oriented. Switzerland, same. And so what it's showing is this growing sales of EVs. And then if you look down here, where the US right here, um, is that millions? Yeah, 3 million. And then the UK, like 1 million, France, the same, 1 million. Um, I think that that's a little more, indicative of the world, more representative, really, of the trend of EVs. So that it's increasing, but a lot of it is being policy driven, and our IRA legislation also incentivizes that because there's a $7,500 tax credit if you buy an EV. There's a lot to that. And then this was something that struck me, and because I know that we talk about this a lot, sort of oil and gas, and then also the energy transition. And this is just a comparison of market caps over the last 5 years. And here's the dating right here, August from 2018 to 2023. And what I'll have you note, though, is in 2018, that was really the onset of a lot of the ESG investing, really heavy into, Europe's green push, really heavy into, we've got to decarbonize that, the COPs and all the global bodies really, really wanting to spur decarbonization. And so you see, NextEra, Ørsted, the Ørsted investors, largely wind energy firms. And they are also, Ørsted and Vestas are both Danish firms, just in FYI. Iberdrola is Spanish, and Iberdrola is really known as a large global utility. And they also have a big presence in the United States. So I think that's why you see this larger market cap reflected. And these dashed lines here is the 2018. So it's just showing how much things have grown relative to oil majors. But here's the color on that. So if you look at Shell, BP, and Total, well, Total stayed the same. Total is French. BP is UK. Shell was Dutch, now listed at the LSE in the UK. Now, those are European majors, and they had been trying to lean in more to the green energy push. They have since had to dial that back since the Russia invaded Ukraine. Now, the US majors have grown. And that's very interesting because they, while they also have CapEx allocated to decarbonization, via CCS or, hydrogen hubs or whatever, Chevron has a little bit different, leanings on some of their picks versus Exxon. And Exxon, has really been rewarded for their, their approach and their steadiness, as an oil major, not going too fast in one direction or the other. And so they've been rewarded for that. Now this is just showing, this is showing some of that. Now this is a 1-year look, and it's just price return. So Exxon up 20%. This is Iberdrola 8%. So green energy. So if you just look at those market cap, graphics, it's not the whole story. You can't just go by market cap, growing market cap. That is just not the whole story of a firm, right? Because there can be momentum, there can be all sorts of things, and that can change, as we have seen between like the triple Q and XLE, which we've talked about before. And this is Vestas right here, down, wind energy, Total up, because the market has liked of late, the last year, Total's reversal from being more green leaning to back to oil and gas weighted. They've been, announcing a lot more investments in that area of hydrocarbons, and so they have been rewarded. BP 20%. They have shifted gears as well, but also oil prices have been rising again for the last many months. CVX not rewarded so much. There's been some. They've had a few issues here and there with like a LNG strike in Australia, and and they just announced a hydrogen play that they're where they're going to be spending some of their decarbonization capex. They've also announced renewable fuels, and so I'm wondering if the market's just not liking their story as much as the Exxon story with CCS and other things versus that. That's one possibility, aside from just, some of the, just little dings they've had. Not as compelled. Fang, I put Fang in here because Fang is, a Texas Permian player. And they've 17% increase in price over the last year. Just steady, just solid, stayed the same. No, no green push. They're not like the larger oil majors. So that's kind of interesting because that kind of also gives you a reflection of a US player, that's just straight up US as opposed to an integrated Exxon and Chevron and BP and the rest. And then this is just showing some of the returns for some of the ESG indexes. So as you can see here on green energy, I'm trying to see if I can make that, I can't make it bigger, down over the last year. Grids up a little bit over the year, but down of late. Water has actually been a bit steady, the Clean Edge Water ETF, and I have one of those water ETFs, and it's just kept humming along. It's not through all the volatility of the last 5 years, and so it's not lost value, and it's just chugged along, which is really interesting. Wind energy down, copper down of late, up in general, lithium down for the year. Uranium down here at the bottom, the uranium miners, there has been of late, some definite positives with uranium, and there's been some positive uranium announcements. I think Lithium Americas had one, and that just has to do with nuclear energy, that with this energy transition, and also there's like $30 billion in subsidies to help to help nuclear energy development in the IRA legislation and in the infrastructure bill. And also, I think there's this realization is if you are trying to meet net zero goals, if you're trying to decarbonize, you're going to need nuclear power. There's development on small scale nuclear modules. That's happening increasingly. So there is kind of this resurgence that, nuclear power provides baseload. And if you're going to be using less coal, then you're going to need baseload. And you can't count on solar and wind for baseload. They're intermittent, and there's all sorts of other issues connected to that until you have, some battery storage, and grids are way more sophisticated. So it's a ways off. This is just showing, this was yesterday, because there was the realization of oil market tightness. And so you had all these oil plays going up. And I also just wanted, and see, the S&P was down a little bit. All the oil stocks were up a bit. All of them, XLE, PXD, FANG, Exxon. And then this is just my semiconductor ETF. And that was up still because there's still a lot of, bullishness on semiconductors and AI, that part of the industry, because there's a lot of attention, there's a lot of investment, there's a lot of announcements. So I think it's just kind of keeping the market peaked in that area, until there's some, new information that reveals things differently. And this is total return. And this is 1 year. And so Exxon, 22%. Energy Transfer, which is, a midstream MLP. I think they're the number 1 or 2 largest in the United States, 23%. A lot less volatility with midstream than upstream. CVX, again, not performing as well in the last year. AMSA is an MLP ETF, and we've talked about them before. They didn't perform quite as well as ET, but they also have, it's an ETF. So there's a diversified group of midstream firms performing differently. Energy Transfer has been performing well. They've had new announcements. They've made some acquisitions. I talked about consolidation before in the industry, and it is becoming, and it's also happening in the midstream space. And they just did a large transaction where they acquired some assets, and so that's scale once again. And so that's a smart strategy. KMI, not so good. Pioneer, also not really doing great in terms of price and so forth. Triple Q up. And then the other thing I just wanted to mention was, I know we were going to talk a little bit about just some gas, natural gas, that kind of thing. So this is really kind of the graph that explains why natural gas grows in the future. And that is because of a growing middle class around the world. This is the addition of people. And in 2030, from 2015, it's like 2 billion, a 2 billion people addition, largely in Asia Pacific. A lot of LNG goes there, a lot of natural gas consumption. And so the growth isn't in advanced economies. We're going to keep, consuming what we consume. But that's where the growth lies. And this is a chart from, it's Brookings, but it's from an Exxon energy update, their annual outlook. And this, I wanted to just show this. So this is from our EIA, our, energy watchdog. And here what they're trying to say basically is, okay, so solar's in the green, wind is in the blue, natural gas. Basically, they're saying, oh, look, the proportion of natural gas in electricity consumption, power gen is declining, the growth. And this is just showing the growth. But if you look at this from 21 to 22, natural gas is starting to grow again. Wind is reducing, solar reducing. So again, that gets back to the base load, answer. And also, as natural gas declined in additions for utility scale capacity, and then the renewables increased, it's not a complete story. It's not the whole story. It's not the final story by any means. So now there's a lot of incentives for wind and solar, absolutely. But as you saw reflected in some of those numbers I showed you from that chart, that table, that there's been some poor performance. And I am not in the weeds with wind and solar stocks. So, but I'm just looking at the numbers, the whole numbers. And then the other thing I was going to show you too is we're going to have a quick look at oil market tightness. The price has gone up. It's near 90. And that has been because of supply, tight supply. I've been talking about it for 6 months, 9 months. I don't even know how long. We talked about it actually in one of our videos after my Sarah week. And that was in February, I believe. And at that point, I had said, I've got the notes, that oil tightness in the market is expected the second half of 23. Well, it's here. And that's just it's gonna keep the price up. And also because demand is not, there's a little more positive news on the demand side, so there's a little more stickiness on all of that and inelasticity. And here is here's one part, only part of the reason. The biggest reason is because of OPEC Russia cuts. But this is the other part of the story, and this is oil production in the United States. And this is over the last year. And as you can see in the Permian, just ever so slight growth. Bakken, same. Eagle Ford, flat. Niobrara, little tiny bit of growth. Natural gas, Appalachia grows a tiny bit. Haynesville, a little more. Permian, a little more because of associated gas having to do with oil production. And so what that's saying is that, the producers are not putting the pedal to the metal on growing production anymore. And we've talked about that. There's a discipline. They're going to try to match up more with supply and demand because they don't want prices cratering. So they're really, more attuned to the market, and also attuned to capital discipline and the shareholder returns that are demanded. And in this age of energy transition, I think it's ever more important that they are, adhering to, what the shareholder wants, because that is the market and that's the driver, aside from the policy. And so that's one thing I know you wanted me to mention. And the other is, I was just going to show you this. So this was from Bloomberg, I think, this morning, and they were just saying, it's geopolitics, not supply and demand, that has been driving the oil price. And they mean it in the broadest sense. And here, right here, this is where, again, the cuts from OPEC and Russia are showing up. And that's a big part of the story, the geopolitics, absolutely. But it's not the whole story. We live in a market. And then here is LNG. And I know you wanted me to mention this. So this is in the second half of 2023, the United States has exported more LNG than any other country. That is a huge feat. We went from 20, in just like roughly 5 years, we were just exporting like just over two BCFs, billion cubic feet. Now it's over 10 and it's growing. And then the next top 2 exporters are Australia and Qatar. So that is really extraordinary. And natural gas prices have been low, and there has been some overproduction. But as you can see from those charts, they're starting to kind of throttle that back a little bit, and it's expected that in 2024, the price of natural gas goes up a little bit, not a ton, but it's supposed to go up. And as we know too, natural gas prices can be very volatile based on the weather. And we've also had these, huge heat waves, which has also been burning a lot of more natural gas as well, because wind and solar has not always been able to, keep up. And this is really specific to the Texas grid. I'm trying to see if there's any other chart worth looking at. Nope, that was it. So I'm going to stop sharing.
So I think the first takeaway I have is that you show the market tightness that's in there. Everyone keeps thinking it's the global influence, like the geopolitics that the slide says. It's not always just supply and demand, but I also get the message here that maybe it's also because, as you said, some of those companies maybe working in the Permian are being kind of conservative with how they approach their business.
Yeah, they are definitely not going to oversupply the market, and even though prices are high, which makes producers want to produce more, which incentivizes production and did in the past, in the early parts of the shale boom, that is not the case because everyone's learned and everyone's been burned, and so, they're going to maintain capital discipline, and they're going to reward shareholders because that's what they want. And especially with this green transition or energy transition, which is a very, very slow moving animal, they know that they need to stay true to an investment thesis, and be the ones left standing in the end, and they have the deep pockets, and the world demands hydrocarbons. It's still 80% of energy demand around the world, so that is just not going to change fast. And some of the work I've been doing with the DCEO article coming up in the latter part of October really speaks to that these are all the infrastructure that we have. These are long-lived assets, and we're not going to just turn that over fast, so.
Let's get into natural gas then. I mean, it obviously can be volatile because of the weather, like you said, but it's going to be possibly an important commodity going forward. I think you alluded to like the middle class growing, and it's not just here in the US. This is a worldwide situation where natural gas is going to have to support this growth.
Yeah, no, definitely. I mean, from everyone I talk to, natural gas grows, for the reasons you said, and also because of base load. If there's a growing middle class around the world, there will be more power generation, and there will be more use of air conditioners, as your standard of living increases, and actually with even climate change, we've seen these stories about, that HVACs have been in demand because, when you're able to spend more with a growing middle class, you're going to buy an air conditioner, you're going to buy a new refrigerator, you're plugging in your cell phone, you're getting internet, you're adding these. Your rising standard of living means you're going to use more power, and then couple that with and with rising connectivity, you also have the growth of tech, more data centers, more wireless connections, more cell towers, all of it, and when you lay on a bunch of digital infrastructure, that also requires power. So growing middle class, increasing digital infrastructure, increasing comfort, all of it, just adds to the demand for power generation. Now, one thing I will also say, because this just reminds me about the EV, situation, is now some of that EV growth in the United States is largely driven by the luxury market, and then there's the tax credits that go along with it. So it is not a market-wide, car industry-wide story. It's a story everybody loves to talk about. It's a story incentivized by the IRA legislation. And it has they have their benefits, absolutely. But I am saying from a straight up investment point of view, for me, that's just not something that I personally invest in, because I'm pretty, I don't know, I'm conservative, I'm long term. Now, of course I dabble in tech, because I'm a big believer in all that, and I dabble in it when it intersects with energy, especially, and when it has to do with energy, and I can see the connection and the needs. So also, one thing that happened with the grid here, we endured 3 months of horrific heat, and there was just a few days back, we finally got a yellow cautionary warning, which meant you better cut back or we're going to have blackouts. And that's not happened, and yet this summer, and I was holding my breath the whole time, and because I understand the state of the Texas grid, and I've done that work, and they were asking, aside from just conserving and don't run your dishwasher, don't do laundry, unplug your EV, and so I was like, wow, can you imagine if you unplug your EV, and it's probably not your sole source of transportation, because most people, an EV is a second car. But can you imagine if you needed to leave, because you have a blackout, you better hope that, you've got enough range to get where you need to go. So that was just like, I was like, whoa, ever since Winter Storm Uri, I was like, I'm glad that I don't rely on that, just personal security. But so they have their place, and it's great. It's great for, air pollution. Love that, but there's just trade-offs, right? And there's it's a bigger story than just, the simple answer of pollution reduction. You have to live with it. So let's get back to market tightness. Does it continue in short term, long term?
Well,
Also,
it's supposed to go ahead.
no,
Finish.
well, I was just thinking, could it be challenged? I mean, there was one point where we were down, I was looking for the data here, like around lower than $70 a barrel, and now we're up to where we're at right now.
Yeah.
I mean, Yeah, I mean, oil prices, that is a hard one. Now, the average projections are that, we're at about, let's just call it 90. And next year, that's kind of what they're thinking still, the EIA, our watchdog. I know that the Paris-based one came out with some numbers, I think today at the end of the day. But of course things can happen. I mean, and oil prices are like one of the most volatile instruments, that exists. And, if we had some really crazy demand destruction decline, that could happen. Supply, everyone's pumping as they can, so there's not going to be a big supply side spike. So it's not going to be driven probably by supply, unless all of a sudden, OPEC and Russia, they're like, you know what, we're going to turn the spigots on, and, but they're not going to do that because they both need higher prices. Saudi Arabia wants higher prices to afford its diversification drive and to be modernizing its economy and to diversify away from fossil fuels some. Russia needs a higher price because of their war. They have to make up for the lesser production. Well, and that's debatable. There's a big gray market. And so, barring some extreme situation, I can't see that changing for the next bit. Again, there's a lot of things that can happen.
If there's always this talk about a recession, and they've got a weaker consumer or things change in the market in terms of, could that be an impact? Is that something that maybe energy investors need to look at?
Yeah, absolutely. I mean, with the interest rate rises, and that's, I think, what you're getting at, we are still, we're still seeing all that filter through. And we've seen it hit a few sectors, like in real estate. Are people cutting back some of their grocery shopping and substituting one thing for the other, cutting back? I think so, absolutely. And so, that could be a factor, just this kind of cutting back a little bit, companies rethinking projects, which then feeds into labor supply, so I think we're kind of like, skating on not thin ice, we're skating on thick ice probably. But I think we're still skating a bit, and so it's hard to see where the puck is going exactly. Sorry for all the hockey metaphors, but
I think people thinking about, obviously there's some stability there within the market that it can keep doing what it's doing, but there could be, I don't say it's going to be cloudy, but it could be, maybe not as bullish as some people may think it might be, or maybe it is. Maybe this is the way to go in terms of a recession, is going some safe like energy.
Well, I know that there's this potential for, there's still this potential and this talk of Europe going into recession, and I know that Germany, there's some definite headwinds in Germany, and in France, I just saw some news about that the ECB is going to just decide whether to keep raising rates, and and that's because of the heat, some of the inflation heat in certain countries, but then it'll be at the expense of others, and then that could cause more recessionary pressures in Europe. And does that then, bleed over elsewhere? China is supposed to be stimulating some, and so it, I know it's like we're kind of like holding our breath, are we really there? But I just say, hold steady. I would just, that I think you're getting at also like value versus growth, right? And to me, I mean, it's really a value time and a bellwether time and that sort of thing. And most of my portfolio reflects that. It's very, aside from tech, there's a lot of, um, basics, energy, water infrastructure, general infrastructure, that sort of thing.
And that's been a conversation we've had in the past videos, infrastructure.
Yeah, no, yeah, we had, and that was, a lot of people watched. There was a lot of watching of that one, because we talked about some of the drivers too, and there was a lot of inflation headwinds, decarbonization headwinds, and something else. And that infrastructure, they act like, a lot of these infrastructure funds, they act like toll roads where there's price increases that get built in over time, and so also like some of the midstream ETFs, it's the same idea. They offer a little less volatility than say oil producers. So I've definitely, I think over time, I've added in more midstream in MLPs to my portfolio to even out some of the fluctuations that can happen with oil producers, except save oil majors, which are diversified anyway. And so that's just, they just run differently than just straight E&P, US E&Ps,
So because you had slides on EVs and green energy, ask a question about that. The performance, if you take I think if you take Tesla outside of the mix, it's kind of middling. It's not very exciting performance for investors. Is there a catalyst maybe in your estimation? Not only because you're looking at obviously at the traditional energy markets, but certainly while looking at these other markets, is there something that there might be something to that, or is that still going to be unexciting for a lot of investors?
No, I think you're right. I think there is like a reality check. Like, okay, we've been really excited about wind and solar and all of it, and ESG, all of it for, many, many years. And then the IRA legislation was like, adding kerosene to that thought process. But then we had the invasion of Ukraine, which again, between that and interest rate rises, it's caused a reset, a rethink. And so I think the market is trying to figure out what are the winners in this energy transition. And I know that there's still a good bit of, solar generation capacity coming online. Now, that's not reflected in those publicly traded stocks. So I'm not, per se, except like some of the big players like Iberdrola and, that kind of thing. NextEra, they're utilities though. So they're diversified. Their mixes are diversified anyway. So that's one way to play those. And then they offer dividends. So that would be one, value type way to play some of that green growth potential, right? And because with some of the nuclear plays, you get into, some volatility and uncertainty. I mean, it seems to be a trend that's sticking, and I'm just kind of like watching that to see the case. But, again, with integrated majors, I think you can't go wrong. And then, they allocate a proportion of their CapEx to decarbonization efforts. So I think you get it two ways. You get the stability, and the performance, and then you also get some, green premium type benefits for not as much cost and not as much volatility. Tesla's a bit of an outlier, really, when you think about it, because like with China, even, I mean, there was a story in Bloomberg just talking about EV graveyards. They're overproducing those, and that's not a good market strategy. Our market will not tolerate that over time. and some things are propped up because of rebates and things like that. But I know that, that happens with new markets. Sometimes you'll have, government subsidies to try to get things off the ground, and then you see how the market responds. And funny enough, in that video I just did on carbon capture between myself and Jonathan Grammer, we talk a lot about all these factors, subsidies and this and that, and the market, and some of what he sees on the ground with projects, so I don't know if I fully answered your question.
Goes in the right direction. I mean, I feel like it's still, like you said, it's still working itself out.
Yeah, I think so. I don't think there's clarity right now. There is some clarity, I believe, with hydrocarbon necessity for energy security, reliability, affordability. Those things have not gone away. They've become important. It's real, and it's true. And we are increasing renewables. We are also doing that, and that's true. You just have to pick the right space to do that in the right way. Maybe it is a utility like NextEra and Iberdrola. Maybe you want to get some of that with Exxon, or even even like Pioneer. I mean, they're using renewables in the field to electrify increasingly, the rigs and things like that. Liberty is an oil field producer. They're trying to do more green things in their oil field services. So, I think it's all happening. It's happening in different ways, and a lot of it is driven by decarbonization, producing more cleanly, however you get there. And I think that's all a good thing. And there's a bunch of strategies that you could employ, to make that happen.
Cool. So I'm going to wrap it up because I've been watching this, and I think I might have dropped off for a second there because of a connection issue, but this is before I do lose you completely. Just one last question. This is the DCO magazine annual thing you're doing here. I don't know if you can give us a teaser, or do we just have to wait until it comes out?
I've been saying things here and there. This will be like one of those puzzles, Can you find the I don't know, the baseball bat in this picture?
Well, if we have to wait, we have to wait.
You have to wait. Yeah, you have to wait. Sorry. But I think I've been alluding to, in terms of investment ideas, I think some of my learnings have been coming through with it. So I could say that. So in fact, there is some benefit of all the research, I think I have diversified more in some respects. And I think I've shared that a little bit. So.
Well, I appreciate the time.
Yeah.
Jennifer,
Thanks. Thanks.
Using lots of AC.
Yeah, not today, thank God. Yeah, thanks so much for having me, Michael.
All right, take care.